the nice appliances, it doesn't mean shit. In multifamily real estate, it's all about the numbers. What's up, fruitful investors? Today's video is all about multifamily real estate and how to calculate for cash flow properly. Now, before I get into the video, I will say that it is completely different than single family real estate. If you're coming from a background of single family real estate, you've read a lot of books, gone to seminars, you need to almost throw all of that knowledge out the window when it comes to multifamily. It is a very different business and one that is strictly pretty much all about business. There's no emotions. It's more commercial, like all about the numbers, all about the cash flow. And this is where the sophisticated and savvy investors tend to go, is multifamily. We all kind of start off in single family, most of us, but once we become more sophisticated and we want more money, more cash flow, we go to multifamily usually. Now, it's not saying that single family real estate is no good or not as good. It's just a completely different business. If you know me or watch my channel, you know I strongly believe in single family real estate. It's where I spend most of my time, most of my investments up to this point are single family because it's so easy and boring. But like I said, if you want more cash flow, more money, you tend to go to multifamily real estate. So the one big difference when it comes to calculating cash flow with multifamily is that it is not done on a monthly basis like we do with single family. Single family, it's all about the monthly expenses with the monthly cash flow, and you're pretty much done. With multifamily, it's really all about the yearly picture. It's more long-term. It's more of a business. So we're looking at it from a financial income statement standpoint. We're looking at yearly income. And then if we really like the property, we're gonna boil it down to monthly to make sure that we're gonna cash flow and be able to sustain this property on a monthly basis. But like I said, it's more about a yearly overview or plan of how we calculate for cash flow, and how we do that is with the net operating income. So this is really number one. Step number one is finding out the net operating income. Now you might be saying, what the hell is NOI? What it is all the money you make every single year after all of the expenses. So we take the gross rents, all the rental income, and we subtract it by all of the expenses, property taxes, insurance, property manager, 5% or your maintenance and vacancy funds, your snow and grass cutting, all of the expenses that it takes to run the property, we subtract that from the gross rents. Let me do an example to show you. Let's say we have a 12-plex, so right here. So we're doing this example on a 12-plex building, a apartment building with 12 units. Now we say that the gross rents on this property is $115,000. That pretty much comes out to $800 a month per unit in this apartment building. So $115,000 a year, okay? Now, let's say that all of the operating expenses, as I said, I'll kind of draw them all out here. So we got our utilities, property taxes, insurance. Right, I can stand here all day writing all of this, running out of room. Property manager, snow and grass, everything. So we're taking all the expenses and we're subtracting it from the yearly rent. So let's say that all of these expenses equal $35,000 a year. Utilities, property tax, insurance, property manager, grass and snow cutting, everything. $35,000 a year in expenses to run this building. So we're left with an NOI, a net operating income. Let's make sure I get my math right here. $80,000. At the end of the year, this property makes $80,000 before our mortgage payments or our financing costs. Now, why don't we include this in the net operating income? It is an expense because it changes from person to person to person. It's not accurate. Buyer number one can put 25% down. Buyer number two puts 35% down or 40% down. Buyer one gets an interest rate of 5%. Buyer two gets an interest rate of 5.5%. So you see, the financing cost can change from person to person to person. And that's why we don't include that as an expense, even though it is, and then an operating calculation, because it changes from person to person. Whereas with the utilities, property taxes, insurance, those don't change. Those are fixed costs. It's gonna be the same cost for me, buyer number one, buyer number two, buyer number three, they're all gonna pay the same, and that's why we only include those. So this building makes $80,000 a year before we pay our debt service or our financing costs. Now, if you want to find out the value of the building, which is why this number is so important, because it leads to cap rate, the second most important term in multifamily real estate that you must memorize and know how to do. So to find out the value of this building, we take the net operating income, which in this case on this building is $80,000. We divide that by the cap rate of the area. So in Kitchener-Waterloo, an average 12-plex, that cap rate is gonna be about 5%. That's a very average, good quality cap rate. And how we figure out cap rate is really by knowing the area and being a specialist, which is where your investment specialized realtor really comes into play. Even more so important in multifamily real estate. I would not recommend doing this on your own and skipping the agent. You must use an investment specialized realtor. Do not use a typical Joe Blow realtor in this game. It's the worst thing you can do. In single family real estate, we can get away with it. It's not advised. Again, I always say use a specialized realtor, but in multifamily, there's no way around it. If you use a crap Joe Blow realtor, you're gonna pay for it in the long run. That is almost a promise. So we take the net operating income divided by the cap rate. Like I said, in this case, an average cap rate in Kitchener-Waterloo is 5%, which will give us the value of the property. In this case, it's an even $1.6 million building. So this is the cap rate. And this is how we calculate for cash flow. So if you like the building and you like the number, there's the cap rate, then we go to the monthly expenses. Then we can boil it down single family wise in a sense and find out how much this building is gonna cost or make us monthly on a monthly basis. But that's how we calculate for cash flow in multifamily real estate. It's more of a more sophisticated strategy, more of an accountant view. Like I said, we don't boil it down per month like we do in single family. It's more of a yearly view. And this is how we get the value of the building as well. So a lot of people don't know how to value multifamily buildings. This is a quick way. So we take the net operating income, we divide it by the cap rate that our realtor is telling us it's worth, which gives us the value. So let's say this building is listed on the MLS for $1.9 million. Now you know it's overvalued, okay? Because multifamily is strictly business, strictly numbers, which is why I love it so much. It's just business. If the number comes out after doing this calculation to 1.6, you don't offer more than 1.6. Now, why wouldn't we do that? Because an appraiser is going to use the exact same formula. Remember, commercial real estate, which if you're using or you're buying 6 units or more, you are now commercial real estate, and all the rules are different. Strictly numbers, business. There's no emotions. The paint colors don't matter. The floors, the nice trim in the units, the nice appliances, it doesn't mean shit. In multifamily real estate, it's all about the numbers. And the appraiser is gonna appraise the building just like this. So if you pay 1.9, because the seller is not gonna move, and you say, fine, I'll give you 1.9, you're gonna have to cough up $300,000 to $400,000, whatever you pay over, because the appraiser is gonna come back and say, it's only worth 1.6, buddy. So if you wanna pay 1.9 or 2 million, you know, you're paying the difference, cash. So, and that's how multifamily works, it's strictly business. So quick overview, that's how we calculate for cash flow multifamily real estate. If you want to see my last video that I posted, multifamily real estate investing for beginners, I go into the cap rates and how to calculate those formulas much more in depth than I did in this video. I just wanted to give you a quick overview of how we calculate for cash flow in multifamily and the major differences from single family real estate. If you like this video, if you learned anything, please click like right below. And if you want to find out more about how to invest in real estate like a sophisticated investor, you can click the link right below this video and get access to my 12 free video series. I'll teach you how to invest in real estate from A to Z and everything in between. If you want to find out more about how you can partner with me, we can buy sweet properties like this together, and I can be your one-on-one mentor and coach, you can find out more about that right about here. I'll see you in the next video.